A lot going on. So let's dive deeper first into the market action, at least stateside, with Barry Bannister, Stifel chief equity strategist. And Barry, we were just breaking down these headlines, and by the day, it seems like things are continuing to move. From your vantage point, how much volatility are we seeing in the U.S. markets, even though today is a down day? A market deceleration in the volatility that we had seen in some of the trading sessions last week. Do you feel like equity markets have kind of gotten over most of the bumps here, even though it seems like the escalation is just getting hotter over in Eastern Europe?
Just before the end of 2021, we wrote a report that said that the market then close to 4,800 would drop to 4,200. Probably in the first quarter, it did during the Ukraine issues. We wrote a report just yesterday with details saying that we think it'll get to 4,050. Currently, that's down 7% from this level, and probably by the end of March. I think the risk is very high. We have commodity disruptions from the Baltic Sea to Brazil. We're seeing a material negative inflation effect come to the U.S. standard of living, food and energy costs. If 104 doesn't do it, $140 a barrel would do it. But we're seeing a tremendous inflationary squeeze. And we've got this monetary anesthesia really for the last 3 years that's been trying to shield people from the realities. But to use the analogy of anesthesia, we have political doctors who can't hide their moralizing, jingoistic goals, but they're trying to cut off an economy that is like a $1.5 trillion financial system. That is their annual GDP in Russia. And it's having a negative effect on markets. And we're seeing it in emerging market credit default swaps, high yield spreads, LIBOR, OIS, which is a scramble for dollars. This is like Lehman in some ways, Lehman Brothers failing, in the sense that it has ripple effects that we don't even know the likes of what it's going to do. So I think there's just way too much anesthesia from free money out there. And what'll happen is the reality will catch up to them and the prices will rise to take away a lot of that money.
Barry, you bring up the L word, Lehman, and I just kind of want to drill down on that because you mentioned that things are getting a little bit concerning when you take a look, for example, at, OIS spreads. I mean, they did get larger, but I've talked to people that said the blowout isn't bad enough to signal any sort of serious liquidity crunch here. And Lehman does seem like a little bit of a different story when you consider that was a U.S. institution. If a Russian bank blows up, it remains to be seen how systemic that would be. But I get your point about the overall caution. I guess my question to you is if we do get back to 4,000 on the S&P 500, is it going to be from a Russian economic collapse or something else?
Well, there's a lot of cross currents going on. For example, China tightened up tremendously in 2021, tremendously. It was in line with all the major tightenings of the last 10 years. And the lagged effect of that, it takes 6 to 8 months, is that in the first half of 2022, they would slow down. And the stimulus they're doing now won't show up until the second half. So you could have that plus what's called the bullwhip effect, less demand for goods after an unusual surge in goods driven by excessive policy stimulus on the fiscal side. Government wrote checks, people bought TVs, treadmills, you name it. And so a sudden fall off in demand, a sudden stop as you get into the second quarter. These things could happen and the market would see them 3 to 4 months in advance, which is why first quarter is so weak. I just don't think we should disregard some of the negatives. As far as a comparison, Russia defaulted back in 1998. Brazil had some trouble, this time not because of commodities. But there's a lot of disruption going on. And we just can't hide the fact that all this television moralizing is highly disruptive. It's a $1.5 trillion financial limb of the economy, and we're trying to amputate it off with monetary anesthesia. And just because people have cash piles doesn't mean that we're not immune to pressure on living standards and market disruption. So yeah, I'm watching essentially everything, and we have our screens wide open.
Yeah, I mean, the overall thesis, I mean, not to sugarcoat it from you, I mean, it sounds a little bit bearish here. So what do you do if you're trying to reposition your portfolio here? Do you go into defensives?
Yeah, we went into the year with above average cash. We also said the major defensives. This within the S&P 500 index. Just use that as an example. There are 11 sectors. 3 of them are outright defensive: utilities, consumer staples like food, beverage, tobacco, and healthcare, such as very cheap biotech. But it's gotten very cheap. It's very cheap now. But also healthcare equipment, supplies, and devices, medical devices. You got to go defensive when the market's down, or go to cash and wait for a better buying opportunity. And that's where we've been emphasizing.